Let's dig into the market story. Lesley Marks is Chief Investment Officer at Mackenzie Investments and joins us here in studio. Good to see you.
Good to see you, John.
It's interesting to see this market reaction where it feels like everybody's still holding the line a little bit on where they want to go. What do you make of that?
Well, yeah, it was really interesting when the CPI came out and the core number was higher than expected. And obviously the market reacted the way we would expect. Yields backed up and futures sold off. But then we saw a little bit of a moderation. And I think what really came in to play was the second sober thought, which is this probably isn't going to change what the Fed is going to do next week. And there's going to be a lot more data to come moving into the end of the year at future meetings. So maybe not the number we wanted to see on the core number, but not enough, excuse me, to change the outcome for the short term.
What do you think the market's overall question is at this point? Whether we're nearing, and I'm going to talk about the U.S. specifically because I know it's sometimes a bit apples and oranges with Canada, but that we're nearing the end of the rate hike cycle, that there's the possibility, like how are they interpreting the monetary policy story at this point when they review each new piece of data?
So I think that the market would probably say that it's a given that we're nearing the end of the hiking cycle. The real question comes down to the higher for longer. So, we're fighting that last mile of inflation. How long is that going to take? So how long are interest rates going to stay up at these elevated levels? That's the bigger question here, because I think we're sort of splitting hairs on whether or not there's 0 more hikes or 1 more hike at this point. I know we're focused on the U.S., but in
Sure.
the Bank of Canada, I think it's more likely that we're done here on the hiking cycle, and I think that's important for Canadian investors to think about as well. So it's not just about the Fed, but also looking around the world, what we're seeing. We've seen very weak economic data coming out of Europe. The Fed's going to be watching that. I mean, we're in a very connected world. So the U.S. seems to be a bit of an outlier here, the economy stronger than expected, whereas other parts of the world, whether it's China, we saw Germany, Canada, we're seeing weakness. And so how long can the U.S. hold on? And that's why the Fed wants the extra time to make the decision.
And is it fair to say, if the question is whether rates stay higher for longer, then the follow question to that, and I assume that would be to fight inflation, the follow question is, where does the economy land? Because there was this long time discussion, do we see an economy that's actually resilient through all of this and you get no recession or so-called soft landing, or does this all end economically pretty badly? Is that also part of the conversation right now?
So obviously the Fed has said in all their language that they're very focused on inflation, but you can't really separate the two because the strength in the economy is what's driving the inflation. And what we're seeing here in Canada is a bit of weakness in our economy, which gives us confidence that we're close to the end of fighting the inflation fight. And even Tiff Macklem commented in his commentary last week in the Bank of Canada's decision. So I think that, focusing on any leading indicators that are showing any signs of a slowing in the economy will be a very strong indication for what the future decision making is going to be for central bankers like the Fed.
Okay, let's put it in the investing ring here now, because I hear all of it here, and great conviction stories in why you want to be here or there. But how are you approaching this as an investor, a professional investor right now?
Well, I think because there is a lot of uncertainty into how far into a slowdown we're going to go. Is this going to be a soft landing? Is this going to be a hard landing? The reality is I think we do have enough signs that indicate we're probably heading towards a soft landing globally. Certainly in Canada, we have many indications of softness, and we already have seen that in our GDP data in Canada. In the U.S., as I mentioned, they've been holding on a little bit better. So right now, the U.S. economy is probably the leading economy when it comes to growth in the sense of surprising to the upside, which would lead me in that direction when thinking about investing, particularly in riskier assets like equities. But with so much economic uncertainty, I think the most important thing an investor needs to focus on is that's not an area or a time when you want to be in very economically sensitive sectors of the economy. So I would be looking more at secular growth stories where I don't have to make that economic bet, because what we don't know is are the central bankers holding on to high interest rates too long? And if that's the case, we could see the economy start to decelerate very quickly.
Because there is an argument that some people make, with Canada, which skews towards a lot of commodity-related companies and financials, that the bank stocks look pretty good longer term. And, energy, the supply story is really helping the price of crude and subsequently energy stocks. But again, it sounds like you're leaning towards a resilient U.S. economy, possibly leading to some outperformance for the U.S. markets?
Well, maybe just to speak to Canada first.
Sure.
So the energy and financials trade, which really drives the Canadian stock market, is obviously very key for a Canadian investor investing in Canada. There's very attractive valuation in both of those sectors. So as a long-term investor, you probably would do very well in those sectors. These tend to be, contrarian good times to buy or invest. We just think that the short term has a lack of catalyst, particularly in the financial sector. When it comes to looking at, sectors more broadly, again, most of the secular growth stories are in industrials or technology, for example, healthcare, consumer names. So those would be the names that we would be more focused on until we have more clarity around the outlook for the economy.
Final question is on tech, which obviously is a key component to that U.S. story. And I think that the challenge for a lot of people is these valuations for certain companies seem sky high, but then you talked about something that maybe is outside of the short-term ups and downs of the economy today that might continue to fuel interest in certain names in that group?
So one example of that would be, of course, something you hear about from many of your guests, artificial intelligence. And I think, there isn't a leadership team or a CEO who isn't sitting around thinking about how is artificial intelligence going to change our business? How can we use that to do things more effectively and efficiently and more productively? And so there's a great example of where we see outsized investment towards a certain area of technology that I think investors could continue to focus on despite the higher valuations that we're seeing across the board.
All right.